Hello everyone, welcome to this episode of Your Life, Your Money. This video is for people in the age band of 45 to 55. It's a crucial age in your lifetime. This is your final chance to build a beautiful life beyond this point. In this video, I'm going to take you through 10 things which you should evaluate, focus, act upon if you have an intention to create a beautiful life beyond this point as well as have a happy retired life. This is NRI Money Clinic for you, and I am Dr. Chandrakant Bhatt, your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Are you an NRI living outside of India for more than 10 years? Have you dreamt of a retired life in India in a beautiful house and a lifestyle of your choice? Your dream can come true only when you take some simple and effective actions today. I will take you through a step-by-step process to make this dream come true in my webinar, Stress-Free Retired Life in India. Hello, I am Dr. Chandrakant Bhatt, financial guide and founder of YouTube channel NRI Money Clinic. I have to my credit creating secured retired life for thousands of NRIs spread across more than 60 countries. If you have an intention to make your dream retirement come true, register for my webinar. More details are in the link below. When you reach the age band of 45, you have finished half of your career or more than half of your career depending on when you started your work as well as how long do you want to work. Age 45 has a lot of experience built in your life. You have spent the first 20, 15 years of your career doing things in a particular way. You are not youthful anymore like the way you used to be in your late 20s or in your 30s or in your early 40s. You are in the middle age. You are a mature individual. Your careers have stabilized. You have done things in a particular way between the first half of your life. Now, if you evaluate your career appears like a cricket match. In the beginning of your career, it looks like a test match, ample time, 2 innings to play. Your age between 25 to 45 is innings 1, 45 years and beyond is innings 2. Now you have reached age 45. At this age, it looks like a one-day match from here onwards. If you look at your life at 50 years of age, it appears like a 2020 match. While the shorter versions of the match looks interesting, but they come with the risk. Shorter the version of the match, if you want to achieve certain things in your life, then the asking rate increases. Chances of success and failure when we evaluate both possibilities exist, and you may tend to do the mistake. For those of you who are in this age band 45, if you are passing through that age, it is time to do an introspection. We can broadly say that two categories of people exist at this age. One, people who have played the first innings well. They have built the skills, they have a good salary, they have led a disciplined life, they wanted to do everything what they have done, they have saved money, they have collected assets, they are comfortable to do it. The problem they may face is a complacency. I have done everything right, so I am a superhuman being. I will never do mistake. This kind of a complacency you might fall into at this age band. The other category of people are the losers. For some reason, either because of the opportunities or because of the circumstances or because of their habits or they didn't focus upon, they are not in a comfortable position. They could be the ones who are staring at a midlife financial crisis. They don't know how the life is going to take them beyond this particular point. Their family life could be a mess. There could be many complications in their life. For both category of people who are doing well and people who are staring at a failed life beyond this point, for both category of people, the rules to play this age band remains the same. There is a good chance if you work on it and if you follow with a discipline and if you work under the proper guidance, even for those people who are staring at a failure in life, it's probably possible for them to recover and build a beautiful life beyond this point. What are the things you need to be doing? I have listed here 10 things you should focus on. Let's look at them one by one. Step number 1 is to evaluate your life. At 45 years of age, introspection. You have spent 15, 20 years of your first part of your career doing certain things. Some things could have done right, some things could not have been done. It's your time to evaluate your life, what happened in the past, and how you can set it right, or how you can gain from this particular experience. One thing I would like to stress here is when you do your evaluation, cooperation of your family, inputs from the family, the contributions of the spouse, everything matters. Therefore, when you evaluate your life, sit with your spouse, discuss everything. What is that you wanted to achieve in life when two of you came together? What happened subsequently? What worked right? What are the unfinished things that you wanted to achieve? What mistakes you made? What mistakes you would like to correct yourself? What are the good things that you have done which you can build upon? List them 1, 2, 3, 4, 5, and that will give you a guidance. You may think I know all these things, but writing down in a pen and paper and getting a concurrence of your spouse makes a lot of difference. Start with this point of evaluating your life. Step number 2, make a list of your assets and liabilities. Let me explain. Assets are those which you have got and which you can liquidate for a monetary value at any point of time. For example, if you have got some money in the bank, you have done some fixed deposit, some mutual funds, some NPS, some policies, some stock investment, parcels of land, real estate here and there. You have given some money to your friend who has promised to return it back. All these things will represent your assets. List all of them down and put a monetary value. Monetary value is what could be the possible liquidation value of these assets. If it is an FD, you have done 50 lakhs FD, so the monetary value is 50 lakhs. But if it is a piece of land, then you have to figure out what is the market value of this or the likely realization you do post the tax. Come to a broad figures. You don't have to be too accurate upon that. Come as closer as possible to know what is your total assets. On the other side, put your liabilities. The liabilities could be real liabilities or the liabilities could be the future liabilities. For example, if you have taken a housing loan and your EMIs are running, find out what is the unpaid principal amount against that housing loan. If you have a credit card loan, that's a liability for you. If you have a car loan, that's a liability for you. You have borrowed money from your relatives, friends, whatever it is, that's a liability for you. You have to return certain amount of money which you have taken from your department as an advance against housing loan or whatever it is, that's a liability. You also need to be paying for future expenses like your children's education and other things. Add all these liabilities which you have to clear. Whether you have a job or not, this should be your liability. Even you can forget for the time being your children's education cost. But running liabilities for which every month you have to make a contribution, list all of these things. Find out what is your liabilities on hand. Now the question of checking the assets versus liabilities. Find out whether you have got more assets or you have got more liabilities. If you have got more assets than the liabilities that you have, at least you can say, I have a positive net worth in my life. I can't say that you are very safe still, but at least by liquidating the asset, you can clear the liabilities. What if the situation is reverse? If you have got more liabilities than the assets, it is a red flag. It's a serious issue. Then you have to think about what shall I do to bridge this particular gap. You have a liabilities of let's say 1 crore of rupee and the total assets that you have on your side is only 75 lakhs. Then there is a negative net worth of 25 lakhs in your life, which means you are passing through a danger zone. If you make mistakes while handling things, then it can result in a serious midlife financial crisis. Those of you who have got more liabilities and lesser assets, you should consider yourself are somebody who do not have risk-taking abilities. This gives you, can you take a risk beyond this point, or you have to play safe, or what is that you need to do beyond this point. Step 3, engage a financial planner. Do not engage a financial planner unless you complete step 1 and 2. First, you have to do your own evaluation first. You have to do your assets and liability statement. Then only engage a financial planner. At 45 years of age, everyone should consider consulting a financial planner. Those of you who have not done anything last 10, 15 years, you have not saved, you have not done anything, you have nothing, you have to go to a financial planner. There is a set of people who call the DIYs, do-it-yourself investors. Even they have to go to a financial planner, take an opinion. Whether you work with a financial planner or not, you should take their opinion. Why a DIY also need to go to a financial planner? The reason is very simple. The life beyond that point is not known to you. What you are staring at is retirement. If you have done things very correctly, probably you might be inclined to retire early. Whether your decision to retire early is correct or you have made a wrong assumption, this has to be checked. There are points you will not know. There are things you do not know. For example, you have assumed retirement to happen in a particular way, but that's not the way the retirement is going to be like. You don't know. You are assuming things, right? Life beyond 60 years till the end of your life is an unannounced quiz. How it will shape up, what happens in life, what happens to your age, how people behave at that particular point of time, the mental faculties, everything is something of a quiz. Only people who have retired and experienced this are people who have worked with a lot of retirees over longer periods of time can get a feel of how things have to be like. One of the mistake DIYs will do is they assume this is the thing. Usually what is a DIY? DIYs are ones who are hesitant to pay a fee to someone else or don't want a financial planner. So you assume things. It could be right. I can't say that you are 100% wrong. There are a few people who have done things in a correct way. But most DIYs, I have no hesitation to say, will not be doing things in an optimal way. So it's better you take the services of a financial planner, see whether you are on right track, any corrections are required, what's the assumptions you made, whether the future holds like that. It's a good idea to take the service of financial planner. Beyond that point, what needs to be done, they will guide you and they'll put a correct path around you. If you're somebody who is looking out for the services of a financial planner, you can make best use of services provided by NRI Money Clinic. We have, to our credit, worked with thousands of families across globe from more than 60 countries, and we have worked for decades together and created happy life for these families. If your intention is to create that beautiful life, happy retired life, then you must experience our services. How you can get our services? Very simple. Our number is given in the description box below. We have also provided a WhatsApp link there. Click on the link, it takes you to the WhatsApp. Let us know what is the help that you need from our side. Once we receive an WhatsApp, our team of experts will get to you and figure out how they can help you. Why delay? Send that message right now. Step 4. Evaluate your insurance needs. Some people may laugh. At 45 to 55 years, should I look at an insurance? The answer is yes. You have to evaluate. After your evaluation, you feel that you don't need it, that's okay. But you have to evaluate. What does it tell? I told you assets and liabilities in step 2. If your liabilities are more than the asset, that's a guarantee that you have to buy insurance if you don't have one. Look at what is the future liabilities, like your children's education, the gap between the assets and liabilities. You are the best judge, or your financial planner will help you. Evaluate. If you think you don't have a risk-taking ability, and if you think if something were to happen to you and your family, your wife, your children, your dependents will go through a troubled time, then it's time for you to buy the required insurance. First, calculate what is the required amount of insurance. Deduct from that whatever the provisions that you have. When we ask people how much of insurance they have, people don't know how much of insurance they have. They say, I pay so much for this policy, I pay so much for the policy. That's not what we are interested in. A financial planner is interested to know what is the sum assured you have got. Which policy you have purchased is secondary for us. For us, what is in case if something were to happen to you, what is that your family can get? That's called the sum assured. If the sum assured that you already have is more than the liabilities that you need to cover, you are okay. But if it is less, or you feel that no, if something is happening and they are put into difficulty, buy that extra insurance right now. One problem you'll encounter if you have to buy insurance at this age is it's not going to be cheap. It's not going to be a guarantee that an insurance company is prepared to give you insurance. Both possibilities exist. It costs for more money, and the probability of insurance company giving you insurance or charging you an exorbitant premium. We can find a way to solve this problem. One way to solve that problem is you need a large insurance and the premium is coming quite high. What you do is, at least you have a problem on hand, you don't have enough money or you don't have enough resources to pay so much for insurance premium, then we can't do anything with the rest of the things that you have to do. Then we have to find a compromising way of doing things. One is, instead of taking an insurance for, let's say, up to 65 years of age, you probably take it up to 60 years of age. So when you reduce the tenure, the premiums will come down. This is option one. Two, let's say your liabilities are 2 crore and you think if a premature death in your case happens, the family is at a disadvantage of paying up 2 crore rupees, then you can't afford at least by 1 crore. So reduce the sum assured or shorten the tenure, but nevertheless buy the required amount of insurance and make sure your families are safe. Step number 5, prioritize retirement planning over everything. Everything, no doubt about it. At 45 years of age, as I said, it's a one-day match. At 50 years of age, it is 20-20 match. If you are 55, it is 20-20 match divided into half. It's an emergency call. You just can't wait. If you have not started your retirement planning by 45 years of age, it is a red flag. You have to prioritize. What is it you have to prioritize retirement over? Two things. One, you have a conflict of interest at this point of time. One is your children are growing. You are looking at these children getting into college in next 5-7 years or maybe within 2 years, and you don't have a retirement plan. When you pay for your children's education, it is minimum 5 years of commitment for you. Let's say you are already 50 and your children are going to go to college in 2 years from now. That means your age is 52 and you have a commitment 5 years after that. That means your commitments will run up to 57 years of age. What is that you are left with if you work till 60? Just 3 more years to plan your retirement. Therefore, it's an emergency situation. First, start retirement plan. When you start retirement plan, see, during your retirement days, apna hath jagannath, don't depend on your children. You have to do things on your own. At least the remaining 15 years, 10 years, 5 years, whatever you can or your financial planner can, make best use of this time to build that corpus and make sure that your retirement is reasonably secure. But if you go with the mindset that let my children finish their education and then I will look at a retirement, make no mistake, you will not have a good retired life. Take my advice, prioritize retirement planning over education of children. Does it mean to say you don't send your children to college? Does it mean to say that you don't contribute for their education? There is a way out for this. Your children can study by taking an education loan. There are several government schemes which are available. Every bank is offering them. Look, times have changed now. Every aspect of education, fees, hostel stay, computers, their study tours, everything can be covered under the education loan. If your children are of good intelligence and they are scoring well, they get good jobs post their education. That should not be a problem. They don't have to complete all the education in one stroke. They can finish undergraduation, then take a break, work for a few years, and then they can do the masters. Many parents do this mistake of forcing children to do all the education immediately after that. That's not required at all. Parents thinking that spending a large amount of money in children's education creates success in the children's life. That is not correct. Right? So you can actually ask your children, let me fund you for undergraduation. Go and take up a job. I cannot afford. There is a conflict here. I am left with no money for my education. You take up a job. These children will not get married. They'll have a handful of salaries and they can become disciplined. They can clear these loans and then they can take the option of higher education. Many times people do wrong higher education because they don't know which higher education is useful for them. See, I graduated in 1984. And I did most of my post-graduation studies after my age 49. I'm 64 now. Just a few months before I did a course in IIM Ahmedabad. Right? So education has no age today. Every institution allows of a particular age to come and join them. All options are available. When they do their masters at a slightly higher age, one, lesser financial commitment, they will be disciplined, they use their own money, they know which course really to join. This will all help them. The second conflict of interest that arrives will buying a house. If you don't have a retirement plan in place, do not commit a disproportionate amount of money to buy your house, and that can again spoil the sports. Postpone your home, start your retirement plan, work with your financial planner. They will tell you what needs to be done. The message to write down here is retirement planning over everything else should be your priority. And again, I request you need help to evaluate something, use our services. Step number 6, a home to live. Now you are beyond 45 years of age. During your retired life, you must have a house. You start thinking. The point that you have to keep in mind here is that develop a clarity about where you are going to retire. Will you retire in India or outside of India? If it is in India, which city you are going to retire? Finally, when you retire, you need to have a house in the city and place where you are going to retire. I would suggest, suppose if you don't have a house in the city where you want to retire, that's okay. Start working on it about 5 years before retirement. By 3 years before retirement, have clarity about how you're going to do it. If you have some parcels of land, you can swap it for the new house. If you have an old house, if you have purchased some real estate in the prior years of your life, you can liquidate that and you can swap it for a retirement home. Instead of buying a home without a certainty of which place you are going to retire, or buying it too early, if you are an NRI, you are buying it too early and your retirement 15 years later, if you buy now, you will land into two troubles. One, you have to pay EMI, which will reduce your contribution to a retired life. Plus, when you come back and retire, you will be retiring in a 15 years older house. So that means the maintenance cost will also be there. So postpone it. And if you can manage between retirement corpus as well as a provision towards buying the house, make some provisions for purchase of the house, invest that money somewhere, preferably in a mutual fund portfolio, let it grow. Your question is, the prices of the houses will go up and I have to pay a bigger price. That's okay. Today, if you buy, you have to pay an EMI. That means you are paying an interest. But if you invest that money, investment returns will offset the rise in cost in the real estate. So that's not going to be a problem at all. If you're working with your financial planner, they're quite well trained on it. They will know how to handle that particular situation. So do not go and hurry to buy a house. Nevertheless, start developing clarity around it. Number 7, children education. I've spoken most about the children education in the earlier point itself. Resist your temptation to send children to fancy school thinking that they'll get a good job because they study in a particular institute. Nothing can be farther from truth than this. Your children could be studying in Harvard. Just because you studied in Harvard doesn't mean that they'll have a very successful life. Success in life comes from various reasons. Their ability to think, their soft skills, their morality, their honesty, their dependability, all these things will decide. Therefore, resist the temptation to overspend on education. If your intention is really to create success in your children's life, that exercise will happen at home. Live a life which your children want to follow. Children will watch you and it will become an indoctrination in their minds. So live that life. Inculcate moral values, inculcate discipline, inculcate the habit of doing a budget in the minds of your children. That creates success, just not the pure education. Point number 8, check your health insurance. If you are fit and fine, you don't need a health insurance at this stage to buy in India. If you're an NRI coming back and living in India. If you have pre-existing disease, diabetes, blood pressure, cholesterol, arthritis, or some chronic ailment, I suggest you have a health insurance in India right now. This will make sure that you will not get a no from an insurance company when you exactly want it post the retirement. But if you are fit and fine and you have no problem, then postpone it till about 2 to 3 years prior to you coming back to India. That is the time you buy your health insurance. Some people have a dilemma. What could be my health status? I can't take risk. I want to keep my health insurance premium less. One way to do that is you buy a top-up plan or a super top-up plan, what in some companies it is referred as. These are the health insurance plans where they cover you for a large sum assured, but they will not cover the first few lakhs of it. Let me help you with an example. Let's say you want a health insurance cover for 25 lakhs. Insurance company gives you a cover for 25 lakhs and they will say, I will not cover the first 5 lakh. In the event of an incident, the first 5 lakh is not covered, but beyond 5 lakh, up to 25 lakh, it is covered. What's the benefit of buying this top-up health insurance plan for you? One, you are transferring a larger risk to an insurance company today itself, and you keep your insurance premium very low. When you buy a top-up plan, it's a fraction of an amount of money that you pay to the health insurance, but making sure that if there were to be a larger bill which you cannot afford, or it leaves a big dent in your family finances, that can be covered. That's the method you follow. Some people say that buying a health insurance today keeps my premium very low. That's not true. It's not a level premium life insurance policy. Health insurance premium, whether you buy it now, 5 years later, 10 years later, keep changing as you move from one age band to the next age band. Your real estate portfolio, evaluate, simplify, and make best use of. If possible, convert that into financial assets. Most people in their prime years will buy some real estate which they don't need. Parental pressure, peer pressure. They buy a plot of land there, they'll buy a small house there, and they think they have seen all success stories in their life. They buy the real estate. By the age 45, they'll be left with so many pieces of this real estate. It makes messy affair. Some in one city, some in another city. Earlier you thought your parent was there to take care of them. Now the parents are not there, or they're getting older. You cannot take control of it. Probably it's a good idea to simplify, sell them off, and convert into a financial asset, a fixed deposit, mutual fund, stocks, ULIPs, whatever that is comfortable to you. Convert them into a financial asset. By doing that, you simplify. A physical asset which needs your physical presence can be converted into a digital asset which you can, with a click of the button, you can control. It will start generating returns for you from the time that is there. You have a plot of land, it will come handy for you only when you sell it for a high premium at a later point of time. It does not have a cash flow. However, if you put it into a mutual fund, it becomes a liquid asset and you see it gaining in value much faster. Simplify your real estate. Too much of real estate at this age, which you cannot control, is not useful to you. The last point, step number 10. Keep a control on lifestyle upgrade. Lifestyle upgrade looks nice when you have a fat salary, when everything is going fine for you. It is a good thing to have. It's a feel-good factor. But life doesn't treat you the same all the time. You could be having a good thing. What if your company closes down or if downsizes? Suddenly, from a good position, you could be landing into a trouble spot. Always keep control on life grade upgrades, particularly after your age 45. If you continue the same life upgrade continuously towards your retirement, what happens is by this time you have become habituated and you will feel fish out of water post 60 years of age. This continuous lifestyle upgrade can spoil your children. Your children may think this is the way the life should go on. The life of your children could be something which is different depending on their abilities, the opportunities that they get. But all throughout their life, this is what they have seen in their parents' life, and parents have no control on upgrade of their lifestyle. Children may think this is the way, and they may take wrong steps in their life, and you could be the person who will be blamed for failure in your children's life. Keep a control. I'm not saying that you become a saint, you unwind everything and go back to the grassroots kind of a thing. No, not at all required. Have a manageable lifestyle. You don't need to change a car every 2 years, 3 years period of time. You see whether it is required. Can you afford it? Ask the question, if something were to happen, can I still afford it? What impact it will leave on my children? And if you get a favorable answer, follow that path. Otherwise, always, every step of lifestyle upgrade, you have to take it with critical evaluation. Dear viewers, hope I have given you these 10 important steps to make sure you have a good life beyond 45 years of age and you have a beautiful retired life post 60 years of age. Implement them from today itself. If it helped you to understand the points to focus upon, do give me a thumbs up. Do not forget to share these videos with your near and dear ones, friends and relatives, and on all the social media on which you are connected with. Our channel grows because of your subscription. If you are somebody who is yet to subscribe for the channel, please hit that subscribe button and press the bell icon. I'll see you again next Friday with yet another thought on your life, your money. Till then, stay safe. Jai Hind.
Press the bell icon for more details and subscribe our channel.